Welcome to the deep dive. You sent us a really remarkable stack of analysis, and it's all centered on the insights of Muki Tenenbaum and Claudio Suchavicki. It paints a pretty vivid and sometimes brutal picture of the AI landscape for 2026.
Oh, absolutely. And we're not talking about small incremental changes here, are we?
Not at all. This is about a huge seismic shift.
Yeah.
It's where the promise of AI finally moves from just being, an abstract investment
Right.
to a non-negotiable demand for actual financial results.
That's the perfect way to put it. Our mission today is really to get past all the hype. We're going to dive into how capital expenditure is reaching a breaking point.
Yeah.
We'll look at how global power is consolidating into the hands of corporations, a phenomenon we're going to call corpo politica.
I like that. Corpo politica.
And maybe most importantly, why the coming agent revolution is set to just dismantle entire industries, including the very idea of brand value itself.
So we're extracting the concrete strategies, the big takeaways, and some pretty surprising shifts predicted for the very near future. Okay, let's unpack all of this. But before we look forward to 2026, I think we have to look back. We need a quick, honest review of the 2025 AI scorecard. Because we can only really gauge the speed of the future if we understand what Tenenbaum says caught him off guard in the last year.
Precisely. And Muki Tenenbaum provides a very, very candid assessment of those 2025 expectations. So we need to figure out what predictions were validated, where the pace just accelerated beyond belief, and crucially, where society and established industries just completely failed to keep up.
Okay, so let's start with the things that Tenenbaum got right, the things he correctly anticipated. I think the main one, which was sadly confirmed by recent news, was the prediction about China's hardware bottleneck.
Yeah.
And the sort of superficial nature of their AI advancements.
This prediction was really rooted in hard physics, Tenenbaum saw, quite rightly, that China's claims of rapidly advancing their LLMs would be, largely illusory.
Illusory how?
AI training, especially for these huge models, it requires incredibly specialized cutting-edge hardware. We're talking about the best GPUs with unbelievably fast interconnects.
Right.
You can only get so far with simulation and software tricks. At the end of the day, without the right silicon, your progress it stalls.
And we just got confirmation of how desperate they are, didn't we?
We did.
The news that China is apparently settling for the inferior H200 GPU from the US. I mean, that's the clearest sign of their handicap you could ask for.
Yeah.
And H200 is basically 2 generations old.
It speaks to a profound crisis of compute. It really does. And to understand why the H200 is so inferior for modern LLM training, you have to look past the raw processing speed.
It's not just about crunching numbers.
Not at all. The critical piece in training with thousands of GPUs is the high-speed interconnect bandwidth. It's about how quickly those thousands of chips can share information during these massive parallel calculations.
So it's like having 1,000 brilliant mathematicians who can only communicate by passing notes.
That's a great analogy. The H200 architecture is fundamentally limited there. It just lacks the throughput of the newer generations. It's like trying to build a modern highway system with, 1950s asphalt machines.
So this just confirms Tenenbaum's initial analysis. The claims of progress were hollow.
Absolutely. Their willingness to buy what is essentially obsolete technology, it just underscores a desperate need for anything they can get their hands on.
And sticking with this theme of stagnation, Tenenbaum also predicted that Europe would, quote, go nowhere in the AI race. That observation seems depressingly accurate, doesn't it?
It's the one prediction that needs the least defense, unfortunately. And Muki Tenenbaum suggests this trend of Europe being a follower, not a leader, could easily go on for years.
2027, 2028.
Even 2029. Europe just lacks that cohesive, integrated corporate ecosystem you see in the U.S. Their primary focus is still on heavy regulation.
Which is important, but...
Of course, regulatory foresight is important, but it is not an engine for rapid innovation. The fragmentation, the lack of venture capital willing to pour billions into high-risk infrastructure. It means they're effectively taking themselves out of the competition for AI dominance.
Okay, so that's the slow movement. Let's shift gears. Let's talk about the speed demons. What genuinely surprised Tenenbaum in 2025? Because some developments they blew all expectations out of the water.
The surprise is really centered on the execution power of the big players. First, Tenenbaum was, by his own admission, genuinely shocked by the speed and quality of Google's comeback.
Right, after some early stumbles.
Exactly. The rapid launch of Gemini 3 showed this substantial leap in quality and power for a large language model. It was a clear sign that their internal engineering machine was firing on all cylinders.
Everyone thought Google was behind, But then Gemini 3 basically reset the entire competitive landscape overnight.
They didn't just catch up, they reset the standard for what quality meant. It was a demonstration that when they focus, their research and engineering depth is, well, it's pretty much unmatched.
And the second surprise.
The second one speaks to just the raw scientific scale of it all, the progress with AlphaFold and protein folding.
Which is largely the work of Google's DeepMind, right?
Yes. And the scale of progress there it's just immense. The sheer, completely unexpected progress in understanding and predicting how proteins fold. It essentially pulled forward decades of biological research into a single year.
So this isn't just a small step in computing.
No, this is a fundamental paradigm shift. In biochemistry, in material science, in medicine, the ability to model these structures accurately, it accelerates drug discovery and synthetic biology on a level people were maybe predicting for the 2030s, not 2025.
And the financial implications of that are still, largely unquantified.
Oh, completely. We haven't even begun to scratch the surface.
So we've got the expected stagnation on one side and this unbelievable acceleration on the other. Now, let's talk about the disappointments. What did Tenenbaum expect to see that just moved much slower or didn't happen at all?
The disappointments, they fall into three really crucial areas: geopolitics, corporate candor, and industry denial.
Let's start with geopolitics.
Okay. So the predicted crisis of an immediate aggressive invasion of Taiwan, it didn't happen. The threat is still there, of course. It's acting as this huge negative intangible on corporate valuations.
I'll get to that later.
Yes. But the immediate escalation that Tenenbaum and others had modeled for 2025 just didn't materialize.
Okay, so the second area is maybe the most socially damning, the lack of societal candor and preparation.
This is a big one. Tenenbaum was surprised by the near total lack of government preparation for the disruption that's coming, the real scale of job displacement.
And the corporate refusal to admit AI was the cause of all the layoffs.
Exactly. This is a profound and, frankly, a dangerous form of institutional dishonesty. Companies all over the world cut huge numbers of staff last year. But instead of just saying the truth, that AI tools, automation, agent systems were replacing human jobs, they hid behind bureaucratic jargon.
We all heard the excuses: reorganization, cost-cutting measures.
Or, as Tenenbaum hilariously pointed out, some even blamed the weather for a bad quarter.
Which is, it's a catastrophic failure of leadership when you think about it. If governments don't know the real reason for job losses, they can't create policies to deal with it.
No UBI, no retraining programs, no tax restructuring, nothing. The lack of honesty just delays the necessary action. It lets policymakers pretend the unemployment is cyclical when in fact it is structural, and it's permanent.
And Tenenbaum argues that this collective denial is only going to make the eventual reckoning more severe.
Much more severe.
And finally, there's the industry segment that should be shouting from the rooftops about this, but is instead in a state of radical denial.
The big consulting and professional services firms.
WPP, Accenture. The giants whose business models are directly threatened by these powerful LLMs and agents.
They're trying to adapt, but their adaptation it's just not enough. Their response is what they call reinvention, trying to bolt AI onto their existing services.
But Tenenbaum has a great line on this.
He does. He says it's not reinvention, which means rebuilding on your existing principles. It's just invention, and a failing one, because it doesn't address the fundamental truth of the matter.
Which is
that AI performs their core tasks, data aggregation, synthesis, strategy faster, cheaper, and with fewer errors. Their refusal to acknowledge that their high-margin, high-human capital era is over. It means they're just running out the clock.
That denial is fascinating. It only lasts until the balance sheet forces a completely different story.
Exactly.
Which sets the stage perfectly for 2026, which Tenenbaum sees as the year the financial reckoning really hits. So let's talk about that pivot, the end of blank checks, ROI, and the financial shift.
This financial pressure has been building for a while. It started with that big market volatility in 2025. We saw that sharp drop in April, which Mookie Tenenbaum attributes to this mix of geopolitical noise and some localized market fear.
Can we just pause there for a second? That April drop, it was partly triggered by the DeepSec crisis. For anyone who wasn't tracking that, what exactly was that?
Right. So the DeepSec incident was basically a high-profile, catastrophic failure of a major, mid-sized AI application company. Let's imagine it was a platform, say, in personalized medicine, that was found to have either faked its training data or had a massive security breach. It led to huge regulatory backlash and a total collapse in investor confidence.
So it wasn't a problem with the foundational AI models themselves, it was an application layer panic.
Precisely. And that panic was combined with real stress from, Chinese deception and tariff talks. It created this moment of extreme fear.
But what's interesting is what Tenenbaum observed.
Yes, he saw that those who understood the situation, who saw it as just localized noise and not a systemic failure of the whole AI thesis, they made huge gains by buying into that panic.
But then the fear shifted.
Right.
It moved on to the sheer scale of capital expenditure, the CapEx.
And that leads us to the core issue for 2026. The brutal, unexpected cost of infrastructure. Building these data centers is not just expensive, it's immensely costly. Land, power, construction.
The scale of the investment in compute capacity, the chips, the interconnects, the specialized cooling, has just blown past all the early projections.
Tenenbaum himself was surprised by how expensive these centers are, especially in the high-density areas you need for low latency. And this rapid spending spree raises serious doubts for analysts.
The big question being, if the revenue doesn't show up quickly, how on earth do these companies repay the massive loans and justify this cost of capital?
And that brings us right to the ROI imperative for 2026, return on investment. The market is done with promises. These trillion-dollar companies now have to prove that the colossal sums being spent are generating real, verifiable revenue.
It's the financial moment of truth.
It is. And Tenenbaum lays out two possible outcomes. One, the ROI proves to be real. The revenue streams kick in fast, maybe from subscription agents or big B2B contracts, and it justifies the spend immediately.
And outcome two?
Outcome two is that the market shows some patience. It understands that monetizing a shift this fundamental takes time, 5 to 7 years maybe, and the volatility dies down as investors settle in for the long game.
The difference between those two outcomes really depends on corporate strategy.
And foresight.
Right.
Which is why Tenenbaum points to Google's big move, buying a data center for $4.5 billion, as evidence that they are operating with extreme confidence, not just speculating.
What makes that move so tactical?
A purchase of that magnitude, especially if the center is already built, implies that clients are ready to go. It strongly suggests Google already has firm utilization rates locked in, maybe from their cloud clients or their own Gemini deployments.
So after their big comeback in 2025,
Tenenbaum says Google knows exactly what they're doing. They're buying capacity based on guaranteed demand, which minimizes their risk.
this whole discussion really helps debunk the bubble myth, doesn't it? We keep hearing comparisons to the 2008 subprime crisis.
But Tenenbaum's analysis draws a very clear line between a temporary stock drop and a true bubble that's driven by reckless borrowed money.
And that distinction is vital.
It is. A true bubble, like subprime, is fueled by leveraged debt. When the assets fall, the whole debt structure collapses. That is fundamentally not how the big AI players are structured.
Microsoft, Meta, Oracle.
They're funding this mainly with their own vast cash reserves or long-term stable debt. The risk isn't insolvency. The risk is something else, something Tenenbaum calls the distraction risk.
Attention scarcity.
Exactly. The danger isn't a financial collapse, it's strategic failure. It's management getting so focused on AI that they neglect their profitable legacy businesses.
Because that corporate and human capital is finite. If all of Microsoft's top minds are on Copilot, what's happening to Azure? Are they leaving the door open for competitors?
Look at the parallel Tenenbaum offers. Meta and the metaverse.
Right.
That project burned billions of dollars, but more importantly, it burned years of management focus. And the analysis points out the irony that the term itself translates poorly in Spanish, making it sound awkward or just bad.
It was a massive diversion of attention.
A huge one. And that pivot probably cost Meta significant ground in the early AI race. When a company is so dependent on the focus of its founder, attention scarcity is a hidden existential threat that doesn't show up on a balance sheet until it's far too late.
And yet, despite all these risks, the big macro signals from the U.S. economy are incredibly positive.
They are.
The huge spike in U.S. GDP growth, 4.6% achieved versus a 3.3% expectation, that speaks to a real underlying economic shift.
That GDP figure suggests the growth is substantial, it's structural, and it's real. Mookie Tenenbaum specifically contrasts this with the growth numbers you see from China, which often lack verifiable data.
So this economic uptick, Signals a deep confidence in the productivity gains from AI.
Yes. The market believes the ROI is coming, even if the timeline is still a bit fuzzy.
That confidence and the consolidation of power it creates, it leads us right into our next big theme. Corpo Politica. Corporations versus countries.
A radical inversion of power.
Tenenbaum argues the geopolitical landscape is no longer being dictated by governments, but by these massive tech corporations.
It is a radical shift. For decades, governments held the ultimate power. They used tax cuts, subsidies, deregulation to attract corporate investment. The state was supreme.
But now,
Now the corporations hold all the cards. Outside of the U.S., Tenenbaum argues, most governments have no meaningful power over these tech giants. Corporate policy, where they build data centers, what rules they follow, that's what will dictate geopolitics.
not the other way around.
Not anymore. Think about the infrastructure we just discussed. If a major corporation decides to build a massive data center in, say, Ohio, that instantly creates thousands of jobs and injects billions into the local economy, it shifts political priorities overnight.
And Tenenbaum predicts that even though we see some diversification, the centers of computing power will ultimately consolidate in the U.S.
It's a consolidation driven by necessity. The U.S. offers regulatory stability, existing infrastructure, and the powerful, implicit backing of the American state. This corporate consolidation grants the U.S. far greater global influence.
Tenenbaum calls it a sincere statement of American power.
It's a power that's not military, but financial and technological. He draws a parallel to the Trump tariffs, which acted as a global toll. Now, these corporations are the toll collectors for global compute, and their allegiance is to the U.S.
We saw a clear signal of this power shift last year with the back and forth between Elon Musk and Donald Trump.
Yes. The initial hostility, followed by that reconciliation, it sent a signal to the world. It is incredibly difficult, maybe impossible, for anyone, even a figure like Trump, to successfully oppose a major global corporation without massive blowback. Corporate power now rivals and in many areas exceeds political power.
And we have to just mention the valuation of OpenAI.
The mother of all unicorns, as Tenenbaum rightly calls it.
The numbers are just mind-boggling.
They almost feel fake. After Amazon's latest investment, the valuation jumped from $500 billion to $800 billion in 3 weeks.
$300 billion in value added in less than a month for a company that isn't even public.
It shows this almost irrational market belief in the future power of these foundational models. The market isn't just valuing profits anymore, it's valuing the right to control the operating system of the future global economy.
Which feeds right back into that huge U.S. advantage. It's a symbiotic relationship, isn't it?
Deeply symbiotic. The companies bring massive global influence to the U.S. In return, being an American company gives them backing and protection no other country can offer. Tenenbaum expects this synergy to just accelerate in 2026, solidifying U.S. dominance.
Okay, let's pivot now to the technological shift. Tenenbaum says we'll define 2026 and 2027, the agent revolution.
This is the core disruption.
And this isn't just about better prompts or more complex LLMs. This is about fundamentally changing how we interact with the world, the single app future.
Exactly. We're moving from passive tools you query to active, personalized agents that execute complex tasks for you. They don't just answer questions, they do things.
And with the ultimate consequence, Tenenbaum suggests, is that your phone only needs one app, the agent itself.
The agent becomes the OS. It handles everything: communication, shopping, information, better than today's siloed apps, and with total personalization.
So you can just ask your agent to book a complex vacation.
And it handles the flights, the hotel negotiations based on your known preferences, the visa requirements, the payments, all in one conversation.
The analysis uses a brilliant analogy for this. Before we get personalized medicine, we get personalized shopping.
Yes.
Like a luxury brand that requires an appointment and knows your style. The agent brings that level of hyper-personalized service to everyone.
And, maybe most importantly, the agent restores your anonymity. You become known only by your agent, who knows you intimately. But the vendors you buy from, they only see the agent's purchasing profile, not your identity.
This is where it gets really interesting. The standards war for these B2C agents.
A huge fight is coming. Google, Microsoft, Meta, OpenAI, they will all fight to make their agent the universal standard.
It's the new VHS versus Betamax.
Or maybe Windows over DOS. It's a battle to set the standard that dictates the language, the data exchange, and how everything else plugs in.
But I want to push back on that. The technical standard is one thing, but the real prize is the financial standard, right? As Tenenbaum points out, it all comes down to who pays whom.
Precisely. The standards war is really a payment flow war. The tech has to dictate the financial dialogue, the commissions, the incentives, the data rights. His analogy from Bible study is perfect. It's not just what was said, but who said this phrase to whom.
So who gets the commission when the agent buys shoes? Who gets the data?
Exactly. And Tenenbaum sees two distinct B2C agent models emerging from this fight.
Let's start with the dominant one, the big company agent.
This is the one offered by the giants, Google, Microsoft, Meta. It'll likely be free or bundled into something like Microsoft 365. The primary risk here is commission bias.
Meaning the agent might not get you the best deal.
It might favor vendors who pay a higher commission, even if it's not the cheapest or best product for you. It creates this huge systemic conflict of interest.
And the other risk is privacy. Even if the agent is a shield, the big company still has all your data.
Correct. The data is still centralized within a trillion-dollar corporation. The big company agent risks becoming just a very sophisticated, hyper-personalized advertising tool.
So what's the alternative? The personal agent.
This is a subscription-based service. You pay a monthly or annual fee, and it works only for you.
So it's built on a non-conflict model.
Exactly. Because you're paying a flat fee, the agent operates without any commission bias. Its only goal is to find the cheapest, highest quality, fastest option for you, and the privacy risks are minimal.
But here's the challenge for me. If a personal agent charges, say, $50 or $100 a month, how can it possibly afford the same multi-billion-dollar compute infrastructure that Google and Microsoft are using?
That is the essential economic tension. The personal agent model relies on massive scale to fund that infrastructure. But the value proposition, the promise that we only work for you, is incredibly powerful. Tenenbaum believes that promise is strong enough that both models will emerge and thrive, serving different parts of the market.
And beyond the consumer, there's the B2B agent.
Right, the business-to-business model. This is just pure, brutal efficiency.
No personal preferences involved.
None. If a company needs to buy 10,000 tons of steel, the agent finds the absolute lowest cost, verifies the quality, and secures the fastest delivery. It's a hyper-efficient procurement manager, stripping out all the human error and legacy relationships from supply chains.
And in this B2B space, Microsoft has a brutal, almost insurmountable advantage.
It's historical. It's structural. Microsoft's entire enterprise system, from Office 365 to Azure, is already deeply embedded in almost every major corporation on the planet.
They don't need to build from scratch.
They just plug the agent into the engine that already runs the corporate world. It makes them the leading contender to set the B2B agent standard.
And Tenenbaum sees this becoming an agent as a service model.
Yes, an agent. The idea that you won't buy the agent as a product, but you'll contract its labor. You'll buy agent hours for specific tasks, like auditing accounts or processing invoices.
Like hiring a temp for manpower, but for a digital worker.
Exactly. Tenenbaum believes this pay-per-hour model is the likely future for Microsoft's B2B services.
This detailed look at the tech brings us, very appropriately, to market dangers. Let's shift from opportunity to the critical risks that Tenenbaum's analysis identifies, starting with a flash crash.
The danger of algorithmic trading causing extreme volatility is a constant fear. We all remember the 2006 event, where one bad order triggered cascading stop losses.
And today, with most orders being executed by AI, the risk of a systemic feedback loop is even greater.
It's profound. The scenario is the algorithms start feeding off each other's sell orders, creating an instant artificial panic that could wipe out trillions in minutes and just destroy investor confidence.
So what's the proposed solution?
It has to be technological. Stock exchanges like NASDAQ will need to deploy their own defensive AI. This means implementing adversarial AI audits independent systems that don't talk to the main trading algorithms.
They'd act like an immune system.
Exactly. Constantly looking for anomalies and feedback loops to stop a flash crash before it can escalate.
And for the individual investor, what's Tenenbaum's advice for personal defense?
It's simple, classic advice. Invest for the long term. If you aren't watching the price every minute, if you understand that life and the market are, as he puts it, a succession of states of mood, then a 10-minute crash has zero impact on your long-term goals.
It requires discipline.
A lot of discipline, but it's the most effective defense there is.
But the analysis points to a much deeper, more structural crisis than a flash crash. The loss of intangible value.
This is the slow-motion catastrophe. This is the existential threat to all consumer-facing legacy companies. Because agents will buy the best and cheapest product based on specs, not advertising.
Which means brand value.
Plummets.
Yeah.
That intangible asset built over decades of marketing just it becomes worthless.
But wait a second. If I always buy Nike because I like the design, wouldn't my agent still buy Nike for me?
Only if it determines that Nike is the best value for you based on objective metrics. The agent operates outside of emotion. If a no-name brand offers a shoe with identical performance, better durability, and a lower price, the agent has no incentive to pay the Nike premium. The brand no longer matters.
So all that brand equity on corporate balance sheets is
Yeah.
fundamentally overvalued. And this leads to what Tenenbaum calls an accounting catastrophe.
This is his most provocative prediction. He believes accounting authorities like GAAP in the U.S. will be forced to step in. They'll have to mandate that companies lower the value of their intangible assets on their balance sheets to reflect this new reality.
So it's not an economic downturn causing a crash, it's a regulatory change forcing a financial contraction.
Precisely. This forced revaluation of assets will cause a massive panic-driven stock market crash. Investors will see company values slashed overnight because of a new accounting rule, not because the business failed.
But even though that sounds terrible, this disruption is framed as a necessary and natural part of economic evolution, right?
Absolutely. It's painful, but it's just capital moving from old, inefficient structures to new ones. Just as companies like Accenture replaced older models of IT consulting, AI will replace the current model of brand-driven consumption. It's a cleansing, really.
Okay, shifting to our final section, let's talk about the big one, the infrastructure constraint. Tenenbaum is clear that energy requirements pose a huge challenge, one that will throttle growth if it's not addressed.
The energy needed to run these data centers is astronomical, and it's growing exponentially. Energy is, without a doubt, the primary long-term constraint on AI growth.
And Tenenbaum is unambiguous about the solution. It has to be atomic energy, nuclear power.
He argues it's the fastest to build, the cleanest, and the most reliably scalable solution we have to meet this massive continuous power demand. And the market seems to agree. You see the sharp rise in uranium prices, which signals a validation of this need.
But infrastructure reality still dictates where you can build these things.
Yeah.
There's this far west dream of putting data centers in remote places like southern Argentina for cheap hydropower.
But Tenenbaum says that's largely impractical because of one thing: latency.
The speed of light.
Exactly. The data centers have to be close to their users. If a command takes too long to travel, the user experience dies. You can't just move the entire global fiber optic network to support one remote data center.
This construction boom, though, creates a huge lift for the indirect beneficiaries, the companies that build the stuff around AI.
This is the key investment insight. The analogy is perfect. Even if the housing market crashes, people still need window frames. In the AI boom, even if one LLM struggles, the companies providing the specialty cables, the cooling systems, the energy delivery, they are all thriving.
Look for less brand, more substance.
Exactly. They are the non-branded winners of this CapEx surge.
Okay, let's use TSMC as a final case study to tie all of this together, geopolitics and corporate value.
TSMC is the perfect example of valuation distortion. They have zero brand value. They're a pure B2B manufacturer with no real competitor, so brand is irrelevant.
But they carried a huge liability, what Tenenbaum calls a negative intangible.
And that negative intangible is the permanent existential threat of a Chinese invasion.
And that threat, he estimates, slashes what, 25 to 35% off the company's valuation?
At least. It's a profound example of how a non-financial geopolitical risk acts like a ticking time bomb on the balance sheet, impacting corporate worth far more than any operational failure ever could.
So what does this all mean? We've covered a huge amount of ground here. The key transitions for 2026 seem clear. The painful pivot from hype to ROI, the rise of corpopolitica, and the coming agent revolution that will just obliterate brand value.
And yet, despite all those risks, the accounting crash, the corporate restructuring Mookie Tenenbaum maintains a strong sense of underlying optimism about 2026 and beyond. He sees these crises not as endings, but as necessary, painful cleansings of the market.
And for the investor, his advice is clear. Focus on the avenues, the big, durable themes like infrastructure and compute, and avoid the side streets of speculative ventures. And most importantly, invest for the long term and stop checking the market every 5 minutes.
I agree completely. That perspective is crucial. And if we connect this all back to the agent revolution, if the future is just one agent app on your phone, operating with total anonymity to negotiate for you, always prioritizing the best and cheapest product,
Right.
it raises a pretty big question. What happens to the current trillion-dollar advertising and branding industry when the consumer's identity is completely shielded and irrelevant to the transaction? Will advertising even survive the death of the emotional purchase? That is a question worth exploring.
Absolutely. We'll leave you to mull over that monumental shift. Thank you for joining us for this deep dive into the insights provided by Tenenbaum and his associates. We look forward to seeing where the agents take us next.
Until then, stay curious.